Good afternoon. It's Friday, the 14th of March, 2008. This is Brian Shannon from AlphaTrends.net, and the market's closed. We had a very volatile session and a volatile week. In fact, the market for the week was only down 71 cents on the S&P 500. Today, it lost $2.57, or about just about 2%. And as I was saying yesterday, we are in a bear market, and a bottom is only going to be known well after the fact. So there's really no signs of a bottom in here yet. It's kind of encouraging in a way that the market didn't get really smashed a lot harder this week. I mean, we had a lot of headline news and risk that we saw. The Fed came in and tried to save the day on Tuesday, but looking at a 4-day chart with a VWAP on it, you can see that basically the average person here who purchased stock after the Federal Reserve actions on Tuesday, it has been is now back to a losing position. Yesterday they got back above that level, and it seemed as though maybe the market was going to recover, and there were some what looked to be encouraging signs with this potential for an inverted head and shoulders pattern. In yesterday's video, I don't know how many times I said high risk regarding any long side trade, so hopefully you didn't fall for the early morning strength as the market did open with a little bit of strength, and it got above that, it was holding above that VWAP for about 10-15 minutes, but then the Bear Stearns news came to light and really just pulled any confidence from this market at all. The market stayed below that VWAP till late in the day. We got a little bit of short covering, but really, again, it was just a blip within this downtrend. As again, obviously, we lost 2%, and it was clearly a day won by the bears. So when you look at the 30-minute time frame, what stands out again is this 132 level, 132. 132 to 133. But what we still see here is lower highs in this area. We saw that first higher high, but then we saw a new pattern of lower highs developing, and we still have these lower lows. So this market remains guilty till proven innocent. This big weekly trend isn't going to turn around anytime quickly. It's going to take a lot of time for a true bottom to reveal itself. So don't be in a hurry to buy things when you see the market make these little short-term moves. It was encouraging, I guess, that we closed back above this level that had been the lows from that gap. But still, there's it's hard to make a bullish case rather. Based on anything you see on any of these time frames. Again, we've still got that 10-day moving average below the 20, which is below the 50. They're all declining, and then we look at the weekly time frame. It's good that we didn't finish down much on the week, and we saw the biggest volume that we've seen all year, and big volume without further downside progress. There's a saying that big volume without further downside progress equals accumulation. I think it's hard to say that we've really seen a sign of accumulation with a 2% loss. But bottoms are the process, and perhaps this is the beginning of that process because the market didn't sell off on much bigger volume. But again, there's no evidence whatsoever. Just that volume is one thing to point out, but buying in here remains very, very high risk, and something I would not suggest anyone does in here unless you're doing it on 1-minute time frames. And again, as I've been saying, only the most aggressive, disciplined, and experienced traders ought to be involved in a market that's this risky. The moves, the volatility is just amazing. I mean, the spiders to fall this much in such a short period of time is truly an amazing move. Hopefully, you were able to catch some of it on the short side. Let's take a look at the XLF. The financials were down 96 cents, or about 3.8%. They didn't close at a new low for the week, and in fact, they didn't even make a new low for the week. Overall, though, for the week they finished with 60-cent loss. I guess that's about, what would that be? A little less than 3%. So huge volume in there again today, which shouldn't be a surprise considering the volume that was in Bear Stearns. And let's go back to the XLF. Wow, I didn't realize it finished down at 30. But the XLF remains in this horrible, nasty downtrend, and there's no such thing as down too much as long as there's more sellers. And as long as we keep getting more bad news like this, then there's people are going to just give up on these things, and maybe we're getting near that capitulation stage. But again, the bottom is a long, slow, tedious process. It doesn't occur quickly, so just don't be in a hurry to do anything in these markets. You look at this 10-minute chart; it's just choppy all over the place. We had a move up towards that 26, 2620 was the level it broke down from. We had a move up there. That quickly failed, and then just more choppy back and forth action. You really can't make the case for any kind of trend in here on the intermediate term time frame. It's more neutral than anything, but the volatility will start to constrict as that bottoming process maybe does begin. It's people, the fear begins to diminish, or people become immune to the losses, and just look at since again, let's take a look at the VWAP. Since the January lows, the average price in here is at about 26.5, and for the S&P 500, the average price since the January lows is right up here, right by that 20-day moving average at about 134. For the year, the average price is about 135. So we've got a lot of people still in a big losing position. If we take a look back at even from the 2006, the average price is way up here. If we go back to 2005, the average price is still way up there. So we've got a lot of people. We've got 3 years worth of gains. Back basically from 2004, 2000. I don't know why that says 4. That's 2005, 2006, and 2007. The average person is losing money in this market. So the momentum perpetuates more selling. There's still a lot of risk in all these markets. The IWM this morning got above that 68 level just so briefly, and looked like maybe it had a chance to do something to the long side. Again, it's never the breaking of an important level that matters most, but the subsequent action. And from failed moves come fast moves. Now today there was obviously some headline risk that wouldn't normally be there to precipitate such a violent move to the downside. But you have to have stops in place. Risk management is job number one. And you look at the average price over the last 4 days here. The buyers and sellers are really, fighting a hard-fought battle in here. As look at the 10-minute time frame, it's just real choppy in here. This is not the type of market that most people should be involved in. If you don't have a professional trading platform, if you're trading off of, internet browser type platforms, I think you're at a severe disadvantage, because you've got to be quick in this market when you get such big volatility, in particular if you use leverage. A lot of people are using the leverage funds. I use them as well, but you shouldn't be using them just for the leverage. You should be using them for ease of entry and that sort of thing. But there's, it just magnifies any risk. So, just be very careful in there. 68, as I've been saying in the IWM, I expect that 68 is going to be a level that's important for quite a while. So, as far as resistance, what quite a while means is anyone's guess. But we're going to need to see some evidence of buying in here, and it's just not there still. The weekly time frame, we did see a lower low in here, and it tested with a little bit more volume, I guess, than this original move to those lows, but nothing encouraging here on this weekly time frame. It looks like the XLF did maybe back in here at this point, when people were calling that a double bottom. Then they call this a double bottom. Now they're trying to call this a double bottom. The market makes lower lows and lower highs. That's the definition of a downtrend. And each time it comes down to these levels, people look for double bottoms, just like they were looking for double tops all the way up here. And eventually it does occur, and you can look at it that way. But the longer term trend is nothing more than the sum of a bunch of these shorter term trends. So the short term trends lead the longer term trends, and what we need to do is learn to know when to step aside. And when you've got all this uncertainty in the market, and it's reflected in this huge volatility and sort of thing, the market's telling you a clear message about trend. There is no trend, so stand on the sidelines. Wait for a true trend to reveal itself. Wait for the market to get easy. You don't have to be in there. There's no reason to be in there every minute of every day trying to make a trade and force something to happen. The NASDAQ 100 continues to be obviously in a horrible downtrend as well. That key level of resistance was tested here a couple times this week, was the 4350 level, and I posed the possibility of if the market got above that level and could hold above there for a little bit, then it would put this inverted head and shoulders pattern into play. It never got above there. This is why you cannot just buy in anticipation, especially when it comes to a reversal. Trend follow through, maybe you can sell short a little bit early and get away with it, but you're going to be punished for your mistakes more severely when you're anticipating. What you want to do is you want to anticipate all potential scenarios, which is why I point patterns like this out, and then you want to wait for price confirmation before you ever put any of your hard-earned money at risk. And then once you have that confirmation from price action only, not from oscillators or from what they say on TV, then you participate and set your stop and manage risk. It's not just buy because it broke past a certain level. That's just as foolish as buying because the PE is 15 and last month the PE was 20. Technical analysis, fundamental analysis, neither of them stands up by themselves in a vacuum. You have to use common sense, you have to lay out all the scenarios and manage risk, and that is always job number one regardless of market environment.